to both of you. Jeff, just on the move right now, we got as high as 161 yesterday on the 10-year. I think we're like 138 right now. The size and speed of these moves does not feel normal. Jeff, what's happening?
Well, I don't think anything's been normal the last year, Sarah. But on that front, we saw yesterday a very weak 7-year Treasury auction, and it coincided with the sell-off in Treasuries. And as soon as you hit the 150 level, it just looked like there was massive stop losses there. And so it's a sharp reversal. It happened very quickly. It kind of normalized a bit. Then we had massive volatility in the afternoon as people were trying to digest what was going on. But I think what I've heard from some of your guests earlier today, I really agree with. Last year, this was all about repricing inflation. And so what you saw there was the break-even spreads with the bonds measured inflation that were pushing yields back up. But we've seen in the last couple of weeks that now the bond market and the Treasury market is starting to believe in the real growth story. That is, real yields are pushing up. And I just think there was something kind of haywire with essentially that stop loss trading there. And you're seeing the reversal today. I mean, the bond market has been oversold. When I'm saying the bond market, I'm talking about Treasuries here. If you look at relative strength in those indices, they've been giving very extreme readings really persistently for like 2 weeks now. So it's due to have a little bit of correction. And so I think you're overshooting both directions here. But I think the story here continues to be that we are in a march higher in yields. And we know that nothing moves in a straight line. There's a lot of volatility here. People didn't think the 10-year would go above 120, 125. They were questioning the Fed, whether they do yield curve control and step in here. And the Fed's committed not to do that at this point. So I think we have a continued rise. We see fair value on the 10-year being north of 2. It's not going to happen overnight. It's not going to happen next month. But it is likely to happen through the course of the year. So I think the volatility is there. It's just people are trying to react all of a sudden. And we hadn't seen any volatility really in the Treasury market prior to that.
Good explainer there. So, David, if Jeff is right and we're going to continue to see rising yields up to 2% on the 10-year or even higher, which a lot of people do think is happening, the consensus would say that could be tricky for stocks, especially tech valuations. But you say not so fast. What's the link?
Well, Sarah, you've talked about it, and I think your guests have talked about it. Certainly higher rates, the textbook story is your discounted cash flow models, your risk premium models all suggest stocks need to readjust a little bit lower to the bond market having been cheaper. I mean, it's a comparable asset. So you have the choice of being stocks or bonds. But one of the things we've highlighted to our customers and clients over the last week or so is this idea that coming off of the zero bound is very different. We really took the entire Treasury market up to 10 years out of the equation. It was 50 basis points or less a year ago, or 11 months ago. And so a lot of portfolios that use Treasuries to hedge, equity portfolios, basically had to shut down the risk parity world. And when yields come back up, a lot of those can re-engage. And Sarah, even the 60-40 mom and pop traditional portfolio of stocks and bonds, the bonds didn't do anything for you. You had nothing there. You had no protection. And now all of a sudden you can buy a bond and get some protection in equity downdrafts. That's a very soothing thing for the equity market because there weren't very many hedges for equities out there when the bond market was priced to near zero yield. So I think people are underestimating coming off the zero bound being a little bit different and how positive that might be for the equity market and bringing in new buyers, or should I say old buyers. But I also think Jeff's right a lot about the idea that this is real yields going up. It's expectations that real growth is going up in the future. Real earnings are going up. Things are more positive, and that's what a steeper curve tells you. A steeper curve tells you we're more normal. If we had a 75 basis point or 50 basis point 10-year note, or even a zero 10-year note, we would look a lot more like Japan or Germany or one of the other Northern European countries. We don't want that. We'd rather have people expecting that a normal yield curve or normal rate rises are coming in the future, as long as it doesn't come too quickly. So I think there's a lot of positive in this, even if there are some traditional headwinds as the bond market cheapens up and becomes an alternative deck.
Shepard Smith here. Thanks for watching CNBC on YouTube.